Morning, everyone. I'm going to give you some insight in today in terms of how we look at markets. We basically manage global markets with Global Equity Fund and the Flagship Worldwide Flexible Fund, and I'll be touching on the Flexible Fund in these slides. So I think the data seems a little bit different to what Fanuel had. Maybe it depends on starting and ending points. But this is the MSCI All Country World Index. It's the forward PE, the blended forward PE over the last 20 years. And we had to submit this presentation about 2 weeks ago, and the forward PE of the ACWI was sitting at about 16.4 times. I checked in this morning, it's now at 18.1 after a strong run after the tariff talk. With a long-term average, or the median, with a 20-year median sitting at about 14.5. So we're looking at spot forward PE at about 23%, 24% above long-term median. Looking at asset allocation starting on the left-hand side, January the 1st, 2025 versus 31st of March, 2025, 2 days before the infamous Liberation Day. This is just displaying how we changed our asset allocation. The main change was equities bringing down from 87% to 73%. Not a major change, but what's it, about 14% decrease in equities. And within that was a reduction of US equities from 53% to 38%, and an increase in cash to 20%. And then we have cash in different areas, US, Japan, Euro, not so much in South Africa. So let me just go back. So why the change? So on the previous slide, I showed you that the markets are pretty expensive. They started somewhat expensive, but now they're pretty expensive. But we never look at valuation in isolation, because markets can stay more expensive for longer than you think, and for good reasons as well, such as strong earnings growth and lower global interest rates. So but prices are more sensitive when valuations are cheaper or more expensive. So we do tend to look for signals to see where the valuations are heading afterwards. So it's a couple of signals, and there'll be a lot of signals that we look at, but I've just highlighted 3 here that are worth mentioning. So the new US Treasury Secretary, Scott Bessent, came in and made a couple of announcements in Q1 of this year. In short, he was saying the economy in the US will slow in the Q1 this year as they cut back on government spending. Cutting spending from a 6% GDP to a 3% GDP equals about $1 trillion less in spending. However, I have been tracking the year-to-date spending of the US government, and they haven't cut back as yet, but that is where they're looking to go, to cut spending from 3 to 6% GDP. He's talking about cutting the government spending because it was too bloated during the Biden era, and that one can expect a hangover in terms of cutting back expenses. And he's putting the first 6 to 12 months of blame on this year's economy purely in Biden's corner, and after that, it will be Trump's economy. So a bit of a kitchen sinking going on at the moment. And then importantly, there's obviously the private sector as well, and what they're trying to do is firstly decrease government spending, and then increase private spending, but it won't happen simultaneously, and so there will be a soft pocket of weakness in the US economy for this year. The University of Michigan does surveys in the US on a regular basis where it asks consumers and businesses questions like how they think the economy is going, etc. And one of the questions on US consumer sentiment showed that sentiment sort of came down quite sharply in Q1 of this year. Consumer and business inflation expectations jumped from 2.5% to 4.5% expected for the next 12 months. Consumers expect change in real income to decrease, and businesses expect business conditions in 1 year's time to sharply decrease. These are soft data, and we'll never act or make asset allocation just on soft data, but it is part of putting the whole picture together. This one is earnings estimates for the underlying companies that make up the aggregate ACWI, and we've seen a decline in earning estimates for 2025, starting all the way from April 22, with a sharpish drop-off coming from October 2024. The line is negative, but it's not significantly negative. It's about a decrease of 5% in earnings estimates. Prices do tend to follow earnings, so this was another signal for us. You would have noticed that we invested 7% in gold bullion, no gold equities, but in gold bullion. The most important reason for us and it's structural in nature, and it started in 2022, where we think gold has overtaken US Treasuries to become the global, truly risk-free asset. What happened in 2022 was Russia invaded Ukraine, which in itself is maybe a short-term bounce for gold, but the structural reason being is that after the invasion, the US froze all Russian foreign reserves, and that includes US Treasury holdings that Russia had. Once they froze those reserves, that meant that Russia could not get a coupon or a yield on the US debt that they held, and they couldn't sell any of their US Treasuries that they held. In theory, this was a freeze of Russian assets. In practical terms, this was a default, which is very important given that the US was seen as a risk-free, US Treasuries were seen as a risk-free asset. So even though the US is able to pay their debt, they weren't willing to. And this for us was a big red flag. And you could see at that time, countries like China, Brazil, and Saudi Arabia started selling down their US Treasuries because they would also be at risk at freezing their US Treasuries being frozen. And central banks globally started buying gold. The other factors that I'm going to mention are more tactical in nature and could drive the gold price up or down in the short term. But geopolitics, safe haven, trade wars, potential stagflation, and diversification. Although worth noting, in the last 2 years, there's been a strong positive correlation between the ACWI/S&P 500 and gold. So our thesis on this will change the moment that we feel that gold is at risk of being the global risk-free asset. We also hold 0% in bonds. So if we look at US debt particularly, the US is on an unsustainable fiscal framework when it comes to debt. Now, I know it sounds simplistic, but when you are buying a bond, you're literally lending somebody money. And if we look at the US, for the first time in history, in early 2024, the US had to borrow money, not just to pay off existing debt as it rolled over, but it had to pay the interest on that existing debt. To put it in practical terms, if you and me had to have a credit card and we maxed that out, and our income couldn't pay for the interest on that credit card, we'd have to get a second credit card to pay for the interest on that first credit card. Obviously, the debt's going to rack up on that second credit card to the point where we can't afford the interest on the second credit card either. Hence, we'd have to get a third credit card. So that's a problem for us. It's difficult now to price bonds, and I'm not saying we'll never invest in bonds. Of course we will, but it's about the risk premium that's attached to US bonds. Inflation in the last 2 weeks has actually become less sticky. The problem is that people are maybe looking forward to tariffs. There's been a bit of a ceasefire, and there could be a one-term effect in the increase in tariffs. But there's less inflation fear that I can see in the last 2 weeks in the short term, other than the once-off uptick in tariffs. Political interference, Trump has tried to interfere with the Fed, but it has been limited. This is where we find it challenging is to find the right risk premium that we attach to US bonds at the moment, and what yield we'll be comfortable holding. And also, also now with the default, the practical default of US debt with Russia also affects that risk profile. And then, in our opinion, SA is priced for happy days. Yes, our real rates are very high. Yes, the central bank could price lower interest rates, but from a political aspect as well, the GNU is in fact priced in a status quo. There is a political risk for us that if the GNU does fall apart, that the yields go up further. So what we're watching, inflation, I think everyone will be watching inflation and US bond yields, rate cuts, maybe rate hikes, spending efficiency out of the US, debt to GDP ratios in the US currently sitting at about 130%. And this is the positive outlook that might happen, or that we think it will happen under Trump's 4 years. So the Fed balance sheet has been doing QE all the way up to, from the GFC up to 2022, and expanded its balance sheet, pumping money into the market, and which has ended up at about $9 trillion on the Fed's balance sheet. Since then, we've had quantitative tightening, or QT, which has brought down the balance sheet, or has actually withdrawn a bit of liquidity out of the market, and that's sitting now at $6.7 trillion. That does give at least a $2.3 trillion capacity for QE whenever Trump feels that he needs to, or the Fed, to pump money into the market. However, inflation would have to be under control before he can do that. And something that we've been thinking about lately as well is the positive effects, even if it's a once-off, that the tax cuts, the US corporate tax cuts, could be coming as soon as July in the US, which could see an increase in EPS revisions or estimates, earnings estimates coming forward. So last slide. In the flexible strategy, our priority is to protect capital, and after that, to generate inflation-beating returns. That's how we think about money in terms of the flexible category. Our funds are equity-centric. Over the long term, equities are the best performing asset class. So in the flexible fund, you can expect our equity holdings to be anywhere between 60 and 95%, with the rest being made up of bonds, commodities, cash. Unconstrained, unlike other flexible, like other flexible funds, and why we like it versus balanced funds, is that it's truly unconstrained. You can hold 100% offshore, you can hold 100% in equities, you're not constrained by any sort of Reg 28 constraints. We're very nimble, we're a small boutique. If we see an opportunity today, we can do the research today, we can look at all the pros and cons of the research today, and we can execute today. Having worked in larger asset management before, it really is a real quiver, or a real tool to have. We're truly global. We started, our first fund was in 2001, so we're almost 25 years old as a firm. We started off as global, we specialize in global, and it's something that we think differentiates from our peers. And yeah, so started in 2001, 25-year-old fund. That's it.